Hey there, welcome to RateWatch for July the 20th. I'm Chris Jones, I'm your host. Thought we'd try something a little different. Normally we send this out by our AWeber email blast, but we thought we might try a little YouTube video, see how that works. Now, for some of you, this is probably the first time you've seen my face, so I hope you're not too disappointed, but hey, you didn't sign up for my looks in the first place. As always, you can access this content either through the AWeber email blast list, which you can sign up for at our website, or you can click on the RateWatch tab on our website. The website's www.thechrisjonesgroup.com or at www.lehilender.com. Either way should take you there. So let's get right to it. Let's look at the market. Today the market is up 15 basis points so far. Yesterday we were down 25 basis points. Now, for those of you who are just joining us, that's, I believe, Tyler, Corinne, and Taylor. Welcome to the show. Hope you're enjoying yourself. A basis point is 1/100th of a point. A point is a percent. So if somebody charges you 1 point on your loan, that's 1% of the loan amount. In this case, we're talking about tracking the Fannie Mae 4.5% 30-year coupon. That's a mortgage-backed bond. And those are sold by Fannie Mae, and that helps to set interest rates. When the price goes down, that means people are selling bonds. That means that the yield on the bond rises, and when that happens, it takes interest rates with them. So today we are up 15 basis points. That means the price is rising. It means more people are buying bonds than selling them. That means interest rates are falling. Yesterday was the opposite. Yesterday we actually lost 31 basis points. We were down 25 most of the day, ended up down 31. That meant that people were selling that particular bond, and that meant that interest rates were rising. And not significantly. We're still looking at about 4.5 to 4.75% on a 30-year fixed, somewhere in the 4% range for a 15-year fixed. It kind of depends on what your situation is and a number of other factors, but that's about where we sit. Let's look at an analysis of this market. We expect interest rates will be rising. Now, we've been expecting that for some time. We haven't been correct. If you've been following our blog, you know that that's true. We've got a couple of things weighing on this market right now, on the stock market, and that's helping keep bonds in this range. One of them is that this recovery is apparently not going to be very robust. We're losing steam in the job market. We've never been able to add jobs in this recovery that we've been in. Also, we're facing at the end of the year the expiration of the Bush tax cuts. That's very bad for those who get dividends and for those who have capital gains. In other words, for pension funds and businesses. These are the biggest drivers of the bond market, of course. So that's been iffy for bonds, and I expect that that will continue to get more and more iffy as we get into the fall and into the winter, and that should drive interest rates a little bit higher. Now, there's a chance that those Bush tax cuts will be extended. They're pretty popular, and right now is not really the time to be raising taxes on business and pension funds. Nevertheless, unless those cuts are extended, or unless there's some significant discussion of extending them, the uncertainty in the bond market is probably going to cause some selling, and that's going to be driving rates higher. So let's talk about action. The action to take, if you've been thinking that now is a good time to take a look at doing something, well, now is a good time to take a look at doing something. Interest rates are excellent. We've pretty much come to terms with the mortgage regulations that have been laid on us over the course of the past couple of years. We'll be assimilating the new federal regulations in the 2,200-page monstrosity known as the Financial Reform Act. The Dodd-Frank Reform Act, and if you ever thought you were in trouble, wait until you have Chris Dodd and Barney Frank writing your financial procedures. But that aside, we'll be assimilating those through the fall as well, and that's going to have an impact on the market as well. It's going to restrict your choice, the number of loan options that you have, and it's going to make those loans more difficult to get. There'll be fewer loan officers, and the pricing on those loans will get worse. So if you're thinking that now's a good time to move, you're right. Now is the time. Well, folks, that's RateWatch for the day. Till next time, we'll keep watching the rates.